Okay, good morning, everybody. Happy Tuesday morning. Here we are, March 19th. It's it was 70 degrees here in southeastern Pennsylvania over the weekend, and it was snowing a little bit last night when I went out to take care of some things late at night. So if you live here with us, you never know what you're going to wake up to. I know we have weather apps and things like that, but if you're in a warmer climate listening here, God bless you. Looking forward to spring, looking forward to summer. But let's look forward to our weekly webinar right now. I've talked about this last week, but I'm going to remind you every week that my goals for you coming out of these webinars and this Financial 15 that we put together at the end, we have this process. We go over some slot updates. That's what I mean by that is it's information that we get from the Ed Slott group, which I think is really great, and it helps us always keep on top of our minds. You as listeners, certainly us as your financial planning team, the issues and things we should be looking out for when it comes to retirement distribution planning, a tax-efficient retirement distribution planning. So we go over the slot updates. I like to talk about the markets list just to keep you in tune with what's going on in the markets, and I read some analyst reports and share what happened in the previous week and some of the key items that are coming up this week. And then we have a financial planning topic. So our financial planning topic, and that's our Financial 15. Our financial planning this week is 4 reasons that you may consider taking your Social Security benefits prior to your full retirement age or age 62. And I'll talk a little bit about how we got there, but we segment out that financial 15 on our recorded videos, and you can find those on YouTube separately from the weekly webinar because you may not want to listen to this entire weekly webinar. It usually goes about an hour. There's a lot of information. And in the video, we also index these sections, and they're called chapters now on YouTube, but so you can just go to the section that you may like. But my goal for you with this education with these weekly webinars is, again, to inspire you to make changes. I like to bring things to you that maybe you haven't heard about in the past, or you may not be considering, or just different ways of looking at things. And it's hard because we were all taught for so many years certain things about what your retirement should look like, or what you may be spending in retirement, or what your tax situation may be. And we know most of those things are not the reality of retirement. So I want to inspire you to make changes to your goals, objectives, and how you are approaching and applying what you have in retirement. I want you to open your mind to different ideas and ways of thinking about planning and investing. So I hear all the time that we do things differently, and I'm excited by that because I don't want to just follow the standard mold and do what everybody else is doing. We're always looking for innovative ways to achieve our goals as a firm and our goals for our clients. So I want you to open your mind to different ideas and different ways of thinking. I want you to be educated. I want you to hear these things. We repeat things over and over again because it's important. So I talk about required minimum distribution issues. I talk about tax planning issues. I talk about investment planning issues. I talk about all kinds of financial planning issues that may have been addressed before. We've talked about Social Security before, but we're going to talk about it again today. The education is important, and those repeated topics are important because I want you to feel confident in the plan and strategies that you have put in place or that you're working to put in place. And these market updates and keeping updated with tax law strategies, I share with you about when I attend the training groups through the Ed Slott group or the training sessions through the Ed Slott group, when we have these thick manuals that we use. And all of this material that we go through, including tax law updates and tax court updates and distribution issues that other people have worked through and so that we can avoid them. It's really important to stay updated so you can make adjustments along the way. And that's my point in that. So I want you to be inspired. I want you to open your mind. I want you to stay educated. I want you to be updated. So join us every Tuesday at 10 a.m. or listen to us while you're on your treadmill or whatever you do for your exercise, out walking your dog or whatever that is, or in little snippets along the weekend. But they're my goals for you with these webinars. So I talked about the outline, and if you haven't already, hit the subscribe, like, and notification button. If you haven't done that already and you're just joining us for the first time, maybe on YouTube, But we have some upcoming events that I want to share with you and remind you. So we've got a live class coming up at Holy Family University, and this is the Changing World of Retirement Planning class. And folks, this is probably the last time we're teaching this version of the Changing World of Retirement class live. It's going to be updated, and I know David McKnight, the author of this program, is in the process of updating this now. But if you want to attend this class live and you haven't done before, or if you just want to do it again, join us starting April 25th and May 2nd. There are Thursday evening classes, and or April 30th and May 7th. They are our Tuesday evening classes. So they run from 6:30 to 9:30 each night. Yes, 3 hours each night. There's a lot of information. You're going to get 6 hours of education, but it is a fantastic program. We also have a movie that we're going to be screening at the fabulous Newtown Theater on May 29th. Now, my staff advised me that I have been giving you the wrong date, but rest assured it is May 29th at the Newtown Theater. And I am very excited. We have a soft launch date for May 15th for Attleboro U, which is going to be an online course education site devoted solely to education. And that continues to progress every single day. And I'm very excited about that, and I'm very excited to share that with you. All right, so let's talk about our Slott Report. So I'm going to share my screen with you here, and we're going to go through this week's Slott Report mailbag and their update report. So here we are. So today's mailbag is about higher education and backdoor Roth conversions, and this one's written by our friend Sarah Brenner. Today's question: I have a client who is under 59 and a half with a small traditional IRA. She wants to cash it in and use the funds for college education for her daughter. If I remember correctly, they can use this without a 10% penalty. Is there a limit on the amount she can take penalty-free for use for college? Really great question. The answer: there is no limit to the amount of funds that can be taken penalty-free to pay for higher education costs. The funds can be used for tuition, room and board, and other expenses that are required by the school. Keep in mind that although the 10% penalty would not apply to any pre-tax funds coming out of the IRA, these distributions would still be taxable. So it's not tax-free, it's a penalty-free distribution of use for higher education costs. Next question: I am interested in doing a backdoor Roth strategy. I do not have an IRA, but I do have an old simple IRA from a previous employer. Does the pro rata rule apply here? And that's from Marcel. So the pro rata rule has to do with when you're doing a backdoor Roth contribution or backdoor Roth conversion. You have to take into consideration all of the IRAs that you have, and you only get to convert a percentage of the amount that you convert in that backdoor Roth contribution or backdoor Roth conversion, however you want to say it. You only get to convert a percentage of the amount tax-free. You'd have to pay tax on a portion, and that's referred to as the pro rata rule. And it is a complicated rule, but if you have questions about that, we of course have a video about that, and I'll mark that. I'll put a link to that video in this description. Let me just take a note. So the pro rata rule is a bit complex, and actually it can be very complex. But if you have questions about that, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. And like I said, I'll link the video for the pro rata rule in the description. So Sarah writes, "Hi, Marcel. Whenever the backdoor Roth IRA conversion strategy is being considered, it is good to think about the possible impact of the pro rata rule or pro rata formula. This formula requires you to consider all of your other traditional IRAs when determining the taxation of the conversion. For this purpose, simple IRAs are also included, as are SEP IRAs. So when you apply this formula, you must also include your old simple IRA along with any traditional IRAs you may have. This means that even if you use the backdoor Roth IRA conversion strategy by making a non-deductible traditional IRA contribution and then converting it, a portion of the conversion will still be taxable. That does not mean that doing a backdoor Roth IRA conversion is a bad strategy, but it does mean that you should expect a tax bill. And you should definitely consult a qualified financial advisor before you do that, because you don't want any surprises with that. So again, from Sarah, here are some good tax tips for tax time tips for IRAs. So here we are. We're deep in tax planning season. Tax planning season is year round for us, but a lot of folks do their tax planning in the first quarter of the year and leading up to the tax filing deadline in April. But Sarah writes, IRAs are an important but often overlooked part of your overall tax planning. As the deadline for filing 2023 tax returns approaches, it is a good time to incorporate your IRA plan strategies with your overall tax plan. You're probably now busy gathering the necessary information to file your 2023 federal income tax returns. You will want to be sure that as you do so, you keep some important IRA rules and strategies in mind. So 2023 IRA distributions. If you received a distribution from an IRA in 2023, that distribution may affect your overall tax situation. Generally, distributions from retirement plans that include pre-tax dollars will be included in taxable income in the year taken. IRA distributions can increase ordinary income for the year of the distribution, which can potentially cause the loss of valuable exemptions, credits, tax deductions, and taxation of Social Security. An early distribution may result in a 10% penalty on top of any income tax already owed for the distribution. Remember that rollover should be reported on your tax return, even though distributions taken in 2023 that are properly rolled over are not included in income for the year. That's an important point. IRA contribution deadline for 2023. It is not too late for you to make a 2023 prior year traditional or Roth IRA contribution. The deadline for IRA contributions is the tax filing deadline, not including extensions. This year, for most taxpayers, that deadline is April 15th, 2024. Having an extension to file your federal income tax return does not give you more time to make a 2023 IRA contribution. SEP or simple IRA contributions work differently. These contributions may be made up to the business tax filing deadline, including extensions. Nothing like simplicity in the tax code, right, folks? If you qualify, making a deductible traditional IRA contribution for 2023 is a valuable strategy to lower 2023 taxable income. Also, making your first Roth IRA contribution now as a 2023 prior year contribution will have the benefits of starting the 5-year period for tax-free distributions of earnings as of January 1st, 2023. That's a great rule. All Roth contributions and conversions are considered to be done for example, 2023 tax year are considered to be done January 1st of 2023 for that tax year, even though the contribution is not actually made until 2024. This strategy gives your client the potential to take qualified tax-free distributions of earnings from their Roth IRA in less than 5 years. That's a really great point, Sarah. Unwanted or excess 2023 IRA contributions. Now is also the time to address unwanted or excess tax year IRA contributions. You may have made a traditional IRA contribution believing you would be able to deduct it, or you made a Roth IRA contribution and discovered your income was too high. These contributions may be removed as an excess without penalty or recharacterization. While the deadline for these corrective transactions is not until October 15th of 2024, your 2023 federal income tax return may be affected. Therefore, doing these transactions now before filing can help avoid having to file an amended return later. Acting now also avoids the potential pitfalls of waiting until the last possible minute to meet this important deadline. No prior year conversions. If you were looking at your 2023 tax situation and thinking that it would be beneficial to do a conversion, there's some bad news. There is no such thing as a prior year conversion. It's too late. A 2023 conversion had to leave the traditional IRA in 2023 and be reported by the custodian on a 2023 Form 1099-R. Folks, I get this question a lot. Because you can make an IRA contribution prior to the tax filing deadline for the following year, people say, well, geez, I didn't do a conversion last year. Can I do one now for 2023 for a previous year, even though I didn't do it by 12/31? You can't do that, unfortunately. If there was if I could have one tax code wish, it would be that we could do prior year conversions, because that would make things a lot easier for us and a lot more accurate from a planning point of view. Alas, that is not an option. QCDs for 2023. It is also too late to do a 2023 qualified charitable distribution. You cannot take a distribution in 2024 and have it count as a 2023 QCD. If you did do a QCD in 2023, be aware that you will not be getting any specific reporting from the custodian showing this. You will only receive a 2023 Form 1099-R showing a distribution, but you will need to properly report the QCD on your 2023 tax return. Be sure that your tax preparer is aware that a QCD was done in 2023 so you can cash in on the valuable tax break. Don't pay tax on that if you don't have to. If you did it properly, there's no tax due on that. So don't let that get messed up. I also have a video about QCDs. I'm pulling up my notepad right now. I'm going to include that in the description as well. QCDs are very, very powerful from a tax-efficient planning point of view. And more and more people are using QCDs, qualified charitable distributions, in their tax-efficient plans. So it's good to stay up to speed on that. Okay, let's talk about the markets. So the overall markets were, really down a bit last week, but not much. There wasn't a lot of activity. So the Dow Jones Industrial Average was up slightly. This is the week ending March 15th. And we'll talk about why this was. There are a couple reasons. But the Dow Jones Industrial Average was up 0.01%, still up 3.22% for the year. The S&P 500 was down 0.09%, still up 7.63% for the year. The NASDAQ was down 0.68%, up 6.5% for the year. And the MSCI World Index, which is the larger developed economies in the world, not including the U.S., that was down 1.15%, up 4.3% still for the year. Emerging markets was down 0.12%. Europe, Asia, and the Far East was down 1.30%. The global small caps were down 1.48%. So that was a trend, obviously, for last week. The bond index, this pesky index that most people invest their bond holdings in, that 7 to 9 year maturity range through bond funds. So that the Barclays U.S. Aggregate Bond Index was down 1.23%. Year to date, it's still down 1.72%. So that's frustrating. People see that the bond holdings as their, if you're just listening, I'm doing air quotes, safe money. But, if you experienced 2022, you should have shaken that thought out of your mind by now, because bonds were down significantly in 2022, as were stocks. So I'm hoping that you've erased that paradigm out of your mind. Bonds are very, very challenging and probably are going to be the riskiest part of and the most difficult part of investing for the next several years. No change in the Fed funds target, obviously. We're still at 5.5%. The 6-month U.S. Treasury was up slightly to 5.32% from 5.30% the week before. The 2-year U.S. Treasury was up significantly to 4.73% from 4.47% the week before, as was the 10-year Treasury up to 4.31% from 4.07% the week before. That's why you saw a drop in bond values, obviously. Let's talk about some analyst reports. So our analyst told us what I told you last week. So on this call last week, the Consumer Price Index report had just come out from the Bureau of Labor Statistics, but Cornerstone tells us that consumer price index rose 0.4% month over month and 3.2% year over year, with the monthly assumptions being in line with expectations, and yearly just slightly higher. Both a touch above. With the core inflation, excluding food and energy prices, also rose 0.4% month over month, and year over year they were up 3.8%, both just above expectations. So what does this mean? The Fed has this goal, and we're going to hear more tomorrow. The Fed has this goal of 2% inflation, and it's a big fight to get to 2%. We were talking about this on on our investment call on Friday. We have 2 investment calls a week, the investment committee calls. And we were talking about this again on Friday. And, from 9% to 3% or 9% to 4% is much easier than 3.2%, 3.8% to 2%. This is going to be with us for a while. So they go on to write, this report does nothing to increase the odds of a near-term rate cut, but also does little to dissuade them from a cut later in the year. The producer price index, or the PPI index, and I pulled up the definition of this from the Bureau of Labor Statistics website just to share with you, again, for education. And the definition from the BLS website is the producer price index program measures the average change over time in the selling prices received by domestic producers for their output. So wholesale inflation, really. Wholesale inflation rose 0.6% month over month, greater than expected in prior month 0.3 reading, while year over year wholesale prices were up 1.6% versus the 1.2% expected. So again, the expectation was 0.3%. It rose month over month. It rose 0.6%. The expectation on the year over year was 1.2%, but the wholesale prices were up 1.6%. So another concern, prices are continuing to increase hotter than expected. So that's a concern when we're talking about the Fed potentially cutting rates. Retail sales rose 0.6% month over month, below the 0.8% gain expected. So another month of relatively weak consumer spending data compared to expectations. They write, with sizable declines being seen if inflation is factored in. The American shopper is key to the global economy and is showing signs of slowing, but not falling off a cliff. We're going to talk a little bit more about that in a moment. So what do we have coming up this week? So Wednesday is the FOMC meeting. So the Fed, that's when they tell us what they're going to do with rates, and everybody's expecting them to hold rates where they are. Thursday, we have leading indicators index. That leading indicators index has been forecasting a recession until last month, so we'll see where that comes up. We already talked about the markets, and I looked at. If you're just joining us, what I do is I get all these analyst reports throughout the week, and I put them right into a file to prep for this meeting. And I read them throughout the week and tag ones that I want to share with you. And some of them, are meaningful, and some of them are not so great. So, or sometimes they just don't really say much. Like BlackRock's a very good analyst firm, but their reports that they have a few that they send out, they really didn't have much to say. A lot of reiteration of what they've talked about in the past. But I'm just looking at the time. Boy, I'd love to share this whole thing with you. First Trust came out with an analyst report that I thought was really interesting. The fellow who writes it, Brian Westbury, the chief economist. I'll just share some excerpts from this for time. Brian writes, we think the obsession with the Federal Reserve is unhealthy. Instead of an obsession with slight policy shifts out of Washington, D.C., we think investors need to be focused on more important matters like the process of innovation, entrepreneurial risk-taking, and corporate profits. In the end, it's these factors that will drive stock market valuation the most, not the changes of the short-time interest rates target by the mandarins of money. So he goes on to write that things have changed a great deal since the last Fed meeting in January. Back then, the futures market expected about 6 rate cuts above 0.25% each year, with the first cut coming in March. No chance that that's happening, right, this month. As of Friday's close, the market was expecting only 3 rate cuts this year, with the first one coming in either June or July. Let's see. So I'm going to sum it up here. And they go on to write, another key issue here is whether the Fed will publicly abandon its 2% target to make it easier on themselves to achieve their goal. We think that will happen eventually, but that's several years from now. Not soon. Several years from now. So that piqued my interest because, really, if we're struggling between the 3s and getting to 2, it may make sense for them to shift their goal and say, okay, maybe we need to focus on a higher inflation target. Even if it's increased 0.5% or up to 3% in the midterm, it may make sense. The Fed likely thinks it would lose credibility if it announced a higher target for inflation and could send long-term interest rates spiraling upward. That's not a risk the Fed will take, particularly in an election year. So they're right. Our advice to investors: listen to and watch the Fed, but don't obsess about it. The changes in monetary policy from meeting to meeting don't matter nearly as much as the productive capacity of the American people. So I think that's really good advice. Let me say it again. They wrote, our advice to investors: listen to and watch the Fed, but don't obsess about it. The changes in monetary policy from meeting to meeting don't matter nearly as much as the productive capacity of the American people. Again, I think that's really good advice. It doesn't matter that it doesn't mean that it doesn't matter what the Fed's doing. It just means focus on other things. And I think that makes a lot of sense. All right, let's go into our Financial 15. So I'm excited about this because this was fun. So this is the Financial 15 segment of our weekly webinar. And if you're just joining us for this on YouTube and you haven't already, please hit the subscribe, like, and notification button. This way you know that you're always going to be the first one to receive notifications about upcoming videos and recordings. We take this recording and this live video and we package it into a recording so you can watch it anytime. So this week's topic is 4 reasons to consider collecting Social Security benefits at age 62 or before full retirement age. So why would I make this video? Well, it was really interesting. A few weeks back, I did a video discussing this fellow, Sarasota Tim. And Sarasota Tim, someone had said to me, I saw this guy on YouTube and he's suggesting that really he's advising and telling you that you should take benefits, receive your Social Security benefits at age 62. And he gave all these reasons why, and he did some math, and he was very, very compelling. He's very committed to this. And it's if you just listen to this fella, it is very convincing. It can be very convincing. So I went and watched the video, and I was really taken aback because his math was wrong. His thoughts about general life expectancy. I don't know about his life expectancy, but general life expectancy. And I don't mean that in any negative way. I just mean that he might have health issues that we don't know about, although he seems healthy. Who knows? But again, it's his situation, and this collection of Social Security age 62 might benefit him, might be the right answer for him, but very strongly advising he is that other people follow suit. And that's obviously not the way you want to attack the Social Security question. I'm going to talk about the process for that, but that inspired me to write an email to our Social Security expert, Heather Schreiber. And I said, hey, Heather, what would 3 reasons be to collect Social Security at 62 in your mind? And Heather, being the overachiever she is, she gave me 4. So we're going to go over those 4 right now. So let me share Heather's email with us. So again, I wrote to her, and this is a picture of Heather, just to keep her in mind. So Heather is our resident Social Security strategist and Social Security expert, and I'll just put a plug in for Heather. You can find her full bio on our website at attleborowealth.com. That's attleborowealth.com, and you go to Teams, and you can find Heather's full bio. You can find Heather's full bio. But Heather's a great resource for us, and certainly one of the most respected Social Security strategists in the nation. And she reviews every potential strategy for our clients and helps us build them out in our financial plans. But I said to Heather, give me 3 reasons that someone might consider collecting Social Security at age 62. So the first thing she says, Heather writes, financial need and stability. Some individuals may need to retire early due to unforeseen circumstances making it necessary to file early, or simply due to an income need that could not otherwise be met. So there might be a sudden reason that causes this. Well, I wasn't planning on collecting my Social Security until my full retirement age, but now things have changed. Maybe it's a loss of a job. Maybe it's a health issue. It could be many, many things. maybe you didn't save as much as maybe you thought you could. You know, there is a retirement savings crisis in this country. We don't see it all the time. You know, the folks we work with, you know, tend to have a significant amount of savings and investments, and we're working on ways of maximizing what they can draw out of their savings and investments and reducing tax and passing things efficiently to heirs, and that's exciting. But there are plenty of people out there, maybe you listening right now on YouTube, that, you know, it makes sense to collect at 62 because that's your lifeline. That's what's going to keep you going for the time that you're still here, and that's, you know, that's respectable, and sometimes that's necessary. So Heather continues to write, health considerations. If an individual has concerns about their health or a shorter than average life expectancy, opting to receive benefits early may be the better choice, particularly if they are single. When married, however, the combined longevity of the couple should be considered, particularly if the unhealthy spouse has the higher income benefit. This was a big point for me with Sarasota Tim. So Sarasota Tim, I've learned since then through comments and whatnot, and that was, you know, I didn't mention that in the beginning, but I had so many great comments from people on both sides of this argument. So this is what inspired me to have this conversation with you about potentially collecting at age 62. What considerations? This is not advice, by the way. This is, again, education. All these factors have to be considered. But one of the things when Sarasota Tim is saying, I collected at 62 and you should too because of this. Well, Sarasota Tim is a single individual, I've learned now. He's got his lifestyle that is being met, I guess, now through collecting Social Security. I really don't think he's thinking about just my impression, he's not thinking about the long term. You know, his life expectancy numbers were stopping at age 80. That's a pretty short goal, right, as far as life expectancy. So I hope he's going to be in great shape going forward. And maybe he's going to have a lot of revenue from his YouTube channel, and that's going to make up the difference. But he's preaching to a lot of people that you should do this. You should do this, and there's no question. He was calling it a scam and a con not to. But people listening may be married, and they may be in the situation Heather was talking about. When married, however, the combined longevity of the couple should be considered. Because even if the one spouse passes at 80, what if the other one lives to 95? Or what if they live to 85 or 86? You know, these income factors coming in from Social Security, that guaranteed annuity that's coming from Social Security, and gets a cost of living adjustment increase every year. In most cases, there's only been 3 times in the past 30 years, I think it's been, where there hasn't been a cost of living adjustment for Social Security. So all these things need to be considered. And as she says, particularly if the unhealthy spouse has the higher income benefit. This is an interesting one here. Opportunity for investment growth. I'm just going to reach over and I'm going to grab my marker for a second, just in case I need to write on this. So, opportunity for investment growth. Some would argue that filing early and investing the income may produce higher returns than the potential increase by waiting later to claim Social Security benefits. So that's an interesting idea, and it may work for you. So the idea being, if you claimed early, not just at 62, but somewhere between 62 and 67, your full retirement age, and the goalposts aren't 62, full retirement age 70. There are other points throughout your life where it may make sense. I am not an advocate for always choosing age 70, but for a lot of people that makes sense, and it's all very individualized. Let me just grab one thing here. The opportunity for investment growth we just talked about. So that obviously can be a good argument, and it's an interesting argument. So you could see some higher returns than the potential increase by waiting later to claim Social Security benefits. But how do you figure that out? Well, certainly the best way to figure that out is through proper financial planning. And you want to see side-by-side comparisons. So what I would recommend is, if you want to consider any claiming strategy along the spectrum, really from 62 to 70, you have an analysis done by a qualified financial advisor and a Social Security expert like Heather. And then you evaluate that in your financial plan. Because if it may be that if you say, well, you know what? If I have this $1 million in my IRA or my non-IRA, and I invest this money and I get, X percentage return every year, what could that mean if I allowed that instead of having to draw that money out or taking that money out to spend? What could that mean? What would that mean if I let my Social Security pay my bills, particularly prior to required minimum distribution age, and allow me to live my retirement lifestyle? What could this grow to? And then what could the effect be? And so my point is, you want to compare that in different scenarios. And a good financial planner can say, okay, well, here is scenario one, and this is the result. This is the result for 2024, and this is the result for 2034, and this is what it looks like in 2044. And to check in along the way to see what that result is. Scenario number two, these are the results in each one of these timelines. And then you could do scenario three, and it could continue on and on and on, as many scenarios, compare as makes sense for you. Then you can make a proper decision, because obviously if you're considering investment growth compared to Social Security, the nice thing about Social Security, it is, like I said, a guaranteed annuity where you continue to have that cost of living allowance every single year. But as I talked about in the previous video, when you collect early, and let's just say 62, and your $1,000 that you're collecting a month, I'm just using general numbers, gets that, called a 2% increase. That is obviously going to be less than if you wait until your full retirement age. And now if your benefit is $1,700 and that gets its same 2% increase, then this increase is going to be much greater than that increase. And that's, again, like I said, where you get that divergence. And then you have to compare the benefit of this investment growth and see what the surplus or deficiency is in your financial plan in each one of the strategies. I hope that makes sense. So that's the opportunity for investment growth. How about a desire to leave assets to heirs? I thought that was really interesting. So by filing for benefits, early filers may believe that they are able to leave more assets to their heirs. What if that's a goal of yours? I want to leave as much as possible to my heirs. So when we talk about financial planning with people in our financial planning process, there are typically two responses. And the first one is, I have a certain amount I want to leave to my heirs, my children, my loved ones, whomever that is, charities, whatever your financial plan is, your estate plan is. I tell this story all the time, but one of my very first clients, they said, I want to leave $400,000 to each one of my daughters because that's what my mother left me. So that was very, very specific for him. And in fact, when he passed, each one of his daughters received over $1.3 million. So that was a really, really great outcome from an estate planning point of view for him and for his heirs. But most people aren't that specific. Most people say, I want to make sure that our goals are met, our needs are met, and whatever's left passes as efficiently as possible. So as efficiently as possible typically means time and tax. We want it to pass as quickly as possible, and we want to pay as little tax. We want our heirs to pay as little tax as possible. So if there's a way, if one of your goals is to leave as much as possible to your heirs when you're no longer here, and you know that your needs are taken care of, so if there's a way that you can collect your Social Security earlier and leave more to your heirs, because Social Security doesn't pass, right? That benefit passes to your spouse, not even the full benefit, because I think you know how spousal benefits work, but we can actually talk about that on another video, and that's a great topic for another video, spousal benefits for Social Security. I'm kind of saying that, so I remember to write that down. But the Social Security doesn't pass to your next generation, so there's no buildup. You don't get any credit for unused Social Security withdrawals. If you do only live to be age 80, other than your spouse, nobody else gets a benefit for your primary insurance amount. So, and that's what your Social Security is based on, the amount that you receive every month. So no heirs other than your spouse get a benefit for that. So if one of your goals is to build as much as possible to your heirs, it could make sense. It could make sense to have that consideration. And you would do the same thing. Have these same scenarios. Scenario 1, Scenario 2, Scenario 3, Scenario 4. Maybe for you, it's not 4 scenarios. Maybe it's just 2. Here's Scenario 1. Here's Scenario 2. All right, what if I collect at 62? What if I collect at 67? What is the outcome? What is the outcome for me? What is the outcome for my heirs? And you make the decision accordingly. But you make it based on your facts, all the accurate information. Consider your needs, goals. Let's go back to our decision process. Consider your needs, goals, and objectives. Gather all the facts and all the accurate facts. Folks, this video I'm bringing to you today, this live webinar if you're watching live. And nobody's chatted, so I hope you're all out there. So say hello if you're out there for me. But these live videos that I'm bringing to you, or if you're watching it on recording, this is not financial advice. This is education. So I hope you didn't hear any part of this that said you should collect your Social Security benefit at age 62. We're giving reasons for considering collecting earlier than your full retirement age, even as early as age 62. But you have to gather all the facts and all the accurate facts. Don't take recommendations from anybody on YouTube. You can take education from folks that wherever you get it, seminars, books, YouTube, that's great, but not advice or recommendations. Gather all the facts and all the accurate facts. Sarasota Tim's math was completely wrong. His understanding of Social Security distribution, in my opinion, completely wrong. His understanding of life expectancy, way off base. But you've got to have all the facts. You should do a Social Security analysis. I shared with you in the second chapter of the Financial 15, talking about Sarasota Tim. I shared with you the actual math using a Social Security analysis that we did using his numbers. So you can contact someone and have them run a Social Security analysis for you. And you can see the side-by-side numbers. What if I take it at 62? What if I take it at 64? What if I take it at age 70? So all these there are many, many different ways to collect Social Security. And if you're married, you can take it at different times. There's over 500 different calculations you can do to figure out what's best for you for taking Social Security. Consult with qualified experts. Don't take recommendations from YouTube. Don't take advice from anybody from YouTube. Use it, like I said, use that for education, but consult with qualified experts and compare your options in a thorough financial plan. Even the Social Security analysis, as good as it is, not all platforms are created equal. That's why we have Heather. So Heather has a really great program, and she isn't, like I said, she's one of the top in the country. So we run all of our situations through Heather, and she's part of our team, talks about our financial planning strategies with our clients. But that doesn't mean that analysis is the end of it. You have to consider your cash flow needs. You have to consider tax. You have to consider your other income. You have to consider your assets. You have to consider all these things, that your expenses. You have to consider all these things that you work through in a financial plan. Social Security is one part of it. Is it an important part of it? You're darn right it's an important part of it, but it is just one part of it. So compare your options in a thorough financial plan. All right, so we talked about the 4 reasons you may want to consider collecting prior to Social Security, and that's financial needs and stability, health consideration, opportunity for investment growth, desire to leave assets to heirs. Are these absolute? Absolutely not. I think you heard me loud and clear. These all need to be considered with your financial plan and with all the facts involved in that. I'm going to repeat again your decision process. Consider your needs, goals, and objectives. Consider all the facts, all the accurate facts. Don't take facts from people on YouTube, especially non-qualified lay people on YouTube. I hear all the time from folks, I should buy this security, or I should collect my Social Security this way because this person, my brother, uncle, cousin, friend, whomever, told me this is the best way to do it. Folks, rely on the expert. There's experts out there that are available to you. If you have questions for us, you can reach us at questions@attleborowealth.com. If you want to schedule time with me, you can reach out to us at questions@attleborowealth.com, and we'll find time for you to help answer your questions. But this is, and I'll just leave my website up here, attleborowealth.com. But again, gather all the facts, all the accurate facts. Have a Social Security analysis done. So we can't do a Social Security analysis for everybody, but you can find people who can do that for you if we can't do it. Consult with qualified experts. Qualified experts. So your expert should be a certified financial planner. They should be a Social Security expert or have a Social Security expert on staff or with access to a Social Security expert. This is very, very specialized advice and analyses. I also think that the qualified person you're working with should be part of like the Ed Slott Master Lead Advisor Group. This is the only group I know of in this entire country that focuses on tax efficient planning and IRA distribution planning and education the way that they do, right? This constant education and really keeping you at the top of your game. And compare your options in a thorough financial plan. So that is our Financial 15 for the week. I hope that was helpful. I hope I helped educate you, inspire you, give you some direction in your education process, and give you some things to think about. If you haven't already, hit the subscribe, like, and notification button. And otherwise, we'll see you next week. I don't see any questions. So have a great week. Take care.